You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational, and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to this very special anniversary episode of the Investing Matters podcast. During this episode, Dave Mutton, the Chief Operating Officer of London South East, and I will share with you the history of the podcast, principles, background, and discuss the 10 episodes so far, our top 5 favorite episodes, and what our global Investing Matters podcast listeners can look forward to in 2023.
That's great, Pete. It's really great to be here. And I can't believe it's been over a year since we actually first talked about this and then decided to do it. And what a fantastic year it's been. We've had some amazing guests on the podcast with really, really interesting interviews. You know, we are so pleased at London South East at what you've done to really tease out from these guests what they really think about investing and what Investing Matters means to them. So it's been fantastic, and we're looking forward to even more episodes to come.
Thank you very much. I'm hoping that in 2023 we'll take it to another level. My hope is that we're going to have some more guests from the likes of USA, Australia, Canada, and obviously some of our homegrown talent in the UK as well.
Fantastic. Well, funny enough, I got here the top 10 episodes so far from this first year. So our best episode is episode 12, Mark Dampier, who is former research director at Hargreaves Lansdown. And then a fairly recent episode, Gervais Williams is at number 2 from Premier Mutton. Then Chris Dillow, who economics writer. Reg Shaw, who was at MD of MHP Communications. Number 5 is John Stepek, used to be at Money Week and now at Bloomberg. And then the next, number 6, George O'Connor, now at Goodbody Stockbrokers. Alex Schlick from Yellowstone Advisory. Janet Moy from Brewin Dolphin, RBC Brewin Dolphin, I should say now.
Yep.
And Edmund Shing, BNP Paribas, and Tim Rogers, former CEO of AB Dynamics. I mean, that's our top 10 episode list. What a diverse range of people we had in there. And they've all had some amazing feedback as well. We got great engagement online through our social channels on Twitter and LinkedIn and Facebook. And it's been fantastic listening to different perspectives on the whole topic of investing.
Thank you, Dave. I think the beauty of what we're trying to do here at the Investing Matters podcast is to bring that diversity, because there's so many different ways of investing or trading. And by having individuals that are journalists, economists, fund managers, and other people that have written books about psychology or are global investors, we enable the audience to learn far more than they would by just speaking to one group of individuals all the time. And that's what we've been trying to do, to educate all of the listeners to the Investing Matters podcast and the global audience that we're trying to reach.
Absolutely. And that's exactly the brief that I think I gave you over a year ago.
Absolutely.
We want to create that timeless content that is valuable to the listeners, if they listen today or listen in 2 years or 5 years, because it's about how to invest, not what to invest in.
Absolutely.
You're never going to get a stock tip on this podcast.
Absolutely.
And it's about think about how to invest, why to invest, when to invest, and of course, when not to invest.
Absolutely agree with you.
Great. Well, I think what would be really interesting for our listeners would be to dive into our 5 favorite episodes. I think you and I talked about this earlier, and we come up with 5. So we'll kick off with the best episodes to date. Number 1, Mark Dampier, former research director at Hargreaves Lansdown. It'd be great, Pete, if you can remind us, about your conversation with him, what you talked about, and what you think is the highlights of that episode. And then we'll hear a clip.
Yeah, I think what I found most fascinating about Mark was his natural awareness of what had been going on regarding Hargreaves Lansdown, and the fact that he was willing to share what was going on there. And obviously we spoke about the Woodford debacle, which was on everyone's mind. It's the elephant in the room regarding Hargreaves Lansdown, but also he was very personable and open and candid about the difficulties of being a entity of the size of Hargreaves Lansdown. So that's what I found fascinating about Mark. And he actually enjoyed it. He ended up saying, I actually enjoyed that interview with you, Pete. Thank you very much. And he got to the point where he was saying, I'm going to make sure I speak to some of my friends and invite them onto the show to be interviewed. So I was really quite relieved, really. It went so well.
That's great. I mean, I think for me, from my perspective, for investors to hear somebody with such a history in the investing sector talking frankly and openly about his investment technique and what he's done in his different roles was great. And exactly, you talk about the Woodford scandal. He pulled no punches. He talked about it very openly and honestly about how it all unfolded. And I think the really important lesson as well is it doesn't matter how good you are, it doesn't matter how well you've invested in the past. Everybody can make mistakes. And, it's a real sobering lesson to think about that. So just be very careful, do your own research, and, it's your money you're playing with. So you've got to do the right thing.
Absolutely. And the fact is that even the experts, which, you look at Neil Woodford and he was like the number one go-to fund manager, absolutely not necessarily made a mess of it, but he was learning lessons as he was going along, because moving from the blue chip sort of entities that he'd always invested in and then moved into loss-making companies and startups. And that's where you're losing your edge from your expertise. So that was a big lesson learned by Neil Woodford in that account.
Absolutely. I saw a presentation a few years back where somebody outlined that exactly how the portfolio evolved over the time of Woodford and how it changed from that very safe, very stable portfolio companies, and it got far more risky over time. And it was almost like he had to double down on those investments to try and recoup the losses. And it was just making things worse and worse and worse. And eventually, the plug was pulled.
So it was diluting the quality. So he had some really good quality companies and was forced to sell the quality companies to underline the smaller ones that he had. So as you say, the dilution of the quality got further and further down. And that's what happened there. So yeah, some great lessons learned from Mark, and he was very candid about it, which I really appreciated.
We had some great feedback on Twitter for this. So fascinating interview of the man who first made me realize equities aren't the only lunch post GFC. I'm not quite sure what that meant. Definitely worth a listen.
Great financial crash.
Right, great. Right, so I got that. Okay. What a fantastic guest. Particularly enjoyed the explanation of the best buy list concept. I remember we heard about that in the... Mm-hmm. Great. So fascinating career and insights. So yeah, the really good feedback on Twitter, and it's great to see our audience engaging with this. And actually, what's really interesting for me on social media is what we've seen very clearly is some of the guests on the podcast themselves are now engaging with later episodes of the podcast, and we're building this whole community around the Investing Matters of like-minded individuals who want to share their expertise, share their knowledge, and actually help and grow people's understanding of what it means to do effective investment.
Yeah, I think the individuals that are in the city that are compassionate and are giving, and I keep using this line on Twitter about kindness matters, they actually get that, in order to grow a community, what you have to do is enable them to become better at what they're doing. And everyone's got a goal of reaching financial freedom. So if you can enable that, and it doesn't matter whether it's someone's investing in stocks, funds, or investment companies, you've still got them in the community. They're not going into a casino, gambling, and then leaving it. They're actually staying in the community for longer. And everyone gets that. And I think the quality of the guests we've had so far have inspired others to go, well, maybe we should go and see if we can get interviewed on the Investing Matters London South East platform as well. So that's building a community of itself. So they're engaging, they're reaching out, they're retweeting some of the stuff that's nothing to do with them. It's like, I've been on the podcast and I like that new guest. I'm going to retweet and share it. So it's been fantastic like that.
Right. It's sharing the important lessons, isn't it? Mm. Okay. So I think we should listen to a clip from Mark Dampier.
So I want to talk a little bit, because obviously the elephant in the room is towards the end, where the media got hold of all what was going on with all things Woodford. That he developed his fund, he went solo, he built it up, the media took it up, and then the media essentially brought it back down to earth again. So share what you can, and just let's talk a little bit about the best buy list, which has always brought a bit of contention, and B, a little bit about the Woodford fund, if we may.
I am a bit limited, I guess, but I suppose I'd actually start off with saying, just using a phrase that a fund manager actually sent to me he said, Mark, you try and do the best for clients, but it just doesn't always work out that way. And effectively, it's that simple in one respect. I mean, I often feel like saying, yeah, we obviously want to do our best, but sometimes you read stuff in the media, you think, actually, our starting point appears to be, well, actually, we deliberately tried to find the worst fund possible and put clients into it. I mean, it's absolutely absurd to even go there. So, the Woodford. I mean, I'd known Neil Woodford for over 30 years. I first met him, but I didn't know. By the way, I didn't know he's not a friend or anything like that. Just a business person that I knew in the business. Like I've known Nick Train for even longer, actually, in that way. But I've never met him socially either. But they were great fund managers, and I have to say, I don't really want to sit here and defend Neil completely, because he obviously made a huge cock up. But what I will say is that up to the gating, he'd made 26 times your money. I think this is off my memory. So, and against the market of 12 times, which is a pretty extraordinary gain. But he did get himself into some kind of mess. But I think the media, I'll finish this really more on this at the moment and say, if he started it, the media finished it. And one of the things I should have probably learned or known, just seeing that I've been dealing with media for a long time, is that they have got a very big influence. And I don't think they always realise how big an influence they had. But all I'd say is that if you replace Woodford's name with Lloyds Bank, you would have had a run on Lloyds Bank, in my view. So perhaps I'll leave it there. So, it's always a humbling, investment's a humbling experience. Maybe that's what I should have started off with when you first asked me. That's one of the things you learn, that, you want to be right all the time, but you're not going to be. And you're always going to learn. And I've said, I'll in another interview with you, I can go through the learning bits as well that we've learned from that. But, it was not a great experience, to say the least. It did bring some tears, and some of those were mine.
No, Mark, I really appreciate you sharing that. It's very, very kind of you to go and share anything with me regarding that. So I know it's been very, very difficult for you and family as well.
Great. So next in our list of favourite episodes, I've got down is George O'Connor, who's currently in analyst at Goodbody Stockbrokers. And I think it was a fascinating interview that you had with George. I mean, personally, from my perspective, I've worked in tech companies for more than 30 years, right from the very early days of e-commerce. And so I really related to the companies that George was talking about and the challenges. And it's also, from a tech point of view, I'm a big fan of science fiction. I think you know that, Pete.
Yes.
And it's always fascinating to see things from science fiction coming into the real world. And, the classic one everyone talks about is the Motorola flip phone was inspired by the communicator from Star Trek. But there are so many other bits of technology that are being brought into the real world by tech companies that we've read about in science fiction. So it's always fantastic to see things on the tech side of things. What I really liked about this interview with George was we talked about the tech life cycle. And it's really interesting to understand, you need to be clear where the company is that you may invest in, where it is in that life cycle. Is it in that growth phase? Or, how big is its addressable market? And, what's the level of competition that they may have before they succeed? So that was great for me. What did you like about that interview?
It was actually quite a radical thing he said to me during the time we were interviewing. And it's when he pulled out and he says, actually, Pete, I actually like profit warnings. And I was like, what? Who likes profit warnings? And I was like, but it made sense. If you've got a really good company and it's had a bump in the road, but everything's still in place, then you're going to get the share price declining. But it's a fantastic opportunity for the contrarian to go in and actually buy, as he called it, a shed load of the stock. So if the share price was at £1 and suddenly, because of something that's a momentary problem, dropping down to 50 pence, you can buy in twice as much as you wanted before. So to be opportunistic. So I thought that was a really good sort of gem for our investors and listeners to think about. If the company's still solid, it's still got all the right foundations, and there's a profit warning, technology or not, could be an opportunity for you to go and research that company and investigate it further and buy. That was really good.
I mean, the bottom line there, isn't it? It's understanding the fundamentals.
Understanding fundamentals and doing lots and lots of research and not being guided by anybody else but your own independent research of your own.
Great. Feedback we had on this was very good. In fact, this is an example where we had some feedback from Reg Hoare, who was a guest on our episode 16 of the podcast. A big thank you to George and LSE for providing educational content to private investors, key learning, run your winners, and the tech sector is looking cheap if you take a long-term view. Obviously, that may not be relevant when you're listening to this podcast.
Absolutely.
But
Absolutely.
It's very, very good feedback.
Appreciate that, candor, mate. I mean, you mentioned your superpower there, and with regards to curiosity, so I'm going to expand on that a little bit, if I may. Which emerging aspects of software and information technology do you envisage as investors we need to look forward to the most? You know, what's going to be the one that's, you know, the internet of 1990, 2020? What are we looking at in your space that investors we should keep a really big eye on?
Okie dokie. So first of all, thank you for talking to the life cycle model of technology. It's a view I absolutely support and subscribe to. And in that, we've seen waves of tech. And you'd say, well, for a sort of growth or a tech analyst, you're going to be looking to track the waves. That is absolutely the case, and I fully support that. One of the reasons why I'm so excited at the moment is that there's so much happening at the tech infrastructure level. Now, the UK has not been great historically in terms of tech infrastructure. Typically, tech in UK is really around the sort of the application of technology rather than the creation of it. However, if we back off onto our life cycle curve and look at infrastructure, we can see there in terms of cloud infrastructure. We look at it in terms of quantum computing. We look at it in terms of blockchain. We look at it in terms of security and privacy. And we also look at it in terms of 5G. In each of these areas, we can see accelerators. And these accelerators will then come to fruition in terms of new use cases and absolutely new startups and new companies. And for me, you can criticize me, Peter, and say, George, do you know what? I've heard about all of these before. And I'm going to say, absolutely, you've heard about all of these before. But the whole sort of time is right. We've wasted 2 and a bit years in terms of COVID and pandemic and lockdown. But if we look at the pattern of usage that really accelerated from COVID. So, for example, work from home. So we can do this, have this conversation pretty much anywhere. And those forces are now being unleashed. So you had the eminent and the hugely impressive Reg Hoare on last week. And in the old days, you would have had to go around to Reg's hallowed offices. And now you can speak to Reg on the end of a connection. And he's possibly golfing in Andalusia, or he's sitting in his swim shorts beside his swimming pool. And that is just a wonderful world that we are living in. We can work longer, harder, but be more productive and do it so much more on our terms. It's a magical world where we are embarking into. Absolutely, your timing today is horrific. NASDAQ is down 30% year to date. In terms of our own UK market, software and tech services down 29%. FTSE 100's all over the place, but down 3%. But this is a great time to have a reset. Tech valuations came off the boil last October, so we're used to it. We know exactly what we're doing in terms of valuations, and stuff that was expensive is now so much cheaper. And we also know why is it cheaper. So yeah, huge opportunities abound.
Yeah, I think it's a very interesting point you make there regarding the almost a hype cycle regarding what goes on regarding certain trends in technology and other industries as well. And we've got so much going on regarding the technology space.
Okay, moving on then. So the next episode that we chose was a really interesting one from Janet Moy, now at RBC Brewin Dolphin. They were acquired by Royal Bank of Canada earlier this year. What I really liked about this episode was, I think it was a combination of somebody with incredible knowledge and experience, but who is also a great communicator. So I think one of the challenges in any sector, but especially in finance, is having a good communicator who can explain things to investors in a way that is easily understandable and relatable. And I think Janet does a great job with that. And I especially liked her passion for ESG investing, so environmental, social governance. And she talked, if I remember right, about setting standards and developing standards for ESG so that individual investors can actually trust what they hear about ESG. We hear about, companies greenwashing and having so-called standards, but they're not really. So I think that was a really, really interesting episode, and another great interview from yourself. So what was it that you took out of that?
Similarly, the ESG aspect, I asked her about that, and she replied, well, I think ESG is an unstoppable trend. So it's clear that, the amount of money that's going to be going into that space. And I think the beauty of it is that more and more investments are going to go into that space. And what she touched on as well is that actually the war in the Ukraine has accelerated the shift to green energy. And we all know what's going on now regarding energy prices and so on and so forth. So which is absolutely spot on. So it's an unstoppable trend.
Yeah, fantastic. Some of the feedback that we had, so there was a great one here. A big thank you to Janet and to Peter. Key learning change to a growth and open mindset. Fixed mindset is not good, and market downturns are an ideal time to invest if you take a long-term view. Agreed. I think it's about that, keeping that open mind, isn't it? I just say it's when is as much an important question as what to invest in.
Agreed.
So, okay, let's hear a clip then from Janet Moy.
Janet, you've got a great interest and passion for all things ESG and ESG investments. What are your thoughts regarding the ESG sector, the growth, and also what's happening in the capital markets regarding it?
Yeah, well, I think ESG is an unstoppable trend. I think it is getting increasingly clear, right? I think from the regulatory point of view, we are just getting more and more regulation demand for ESG related disclosure, and more investments will be going to the field. I think the war in Ukraine further accelerates the shift to green energy, so that certainly helps with the E. Environmental related investment is really the key of the ESG investment so far, because the investment theme of environmental is just more apparent than the S or the G. So I think more and more investment will be going to the renewables. This is unstoppable, right? With everyone trying to transition away from fossil fuel, and more so with the war going on. It will be a multi-year process. It's not going to be near term. Near term growth style is suffering at the moment. So the ESG related style also related to the growth style is also suffering, but the longer term trajectory remains intact. Supporting from both a consumer preference point of view, regulatory point of view, and just the need to transition to greener energy. So I think we're very positive on the sector.
Okay, so the FCA published the ESG integration into UK capital markets report recently, to which Richard Stone, the chief executive of the Association of Investment Companies, responded, "It's vital that investors can trust ESG data and ratings which are increasingly used in investment decision making. So we strongly support the FCA's view that greater regulatory oversight is essential to provide reliable and objective information." How is the regulatory status quo at the moment, and does it need to be improved?
Yeah, I think there's still, a lot of discussion and lack of clarity on the standardization of how you look at ESG, right? There are a number of providers that provide some more quantitative analysis of ESG, but I don't think there is really a gold standard, like a standardized approach that is approved by a single body that is applied globally. It is just not there. So I think a lot is still up to the investors' interpretation itself. So that makes the caliber of those ESG professionals so important. There can be a wide disparity of those people in the field, with those who really know what they're doing versus those who may be very likely to subject to greenwashing potentially, which is increasingly a problem and which is being really actively invested by regulators more and more so. So I think there is opportunity when there is such discrepancy and lack of clarity going on. So the best of the field will certainly benefit from the trust of the public. And I think, definitely more needs to be done in order to create that trust in the public.
I love that reply. Now, can you share with us how Brew and Dolphin are working within that space and what you and your team are doing on the ESG front, please?
Yeah, certainly. We integrate ESG in our investment process. So it's a few pillars, really. It's like we consider ESG criteria in all our investment aspects. We also offer more specific ESG driven investment that people, when they have a higher standard or they really want specific ESG goals, then they can also access those investments. We have a dedicated team to select the funds and put them together in a portfolio that people can choose. I mean, also from a corporate perspective, we also, we are dedicated to ESG. Like we sign up for net zero. So it's really embedded in both from an investment perspective or whether you're talking about day-to-day, the running of the corporation perspective. And we have expanded our team in the ESG area. And we also have many processes. You mentioned about the trust. So we have a number of processes in place, like controversy tracking, for example, that really enables us to distinguish between the genuine ESG focused companies versus those who are not.
Okay, so we're on to number 4 on our list, and that is John Stepek, executive editor of Money Week at the time of the interview. But now I believe he's moved over to Bloomberg.
Bloomberg now, yeah.
What was it about that interview that you remember best?
I think it was what he was saying. It was two aspects. He was talking about the magazines, because obviously he's a magazine guy at Money Week. And he was saying if it's on the front cover, it could be very, very contrarian. So therefore, keep an eye on what's on the front cover. And usually it's a case of either if they're saying it's a bull market, that means that the market's possibly peaked. And if it's a trend, that's usually a trend that's going to be rolling over shortly. And I think the other aspect was talking about markets. At the time we were speaking, the Dow was up 900 points one day, 1,100 points down the next day. And it was basically saying, this is what I'm talking about. Do not be a day trader. Always look at the fundamentals and invest long term. I think that was really, really quite a poignant thing to be thinking about. To stay in the market and not get shaken out, but don't trade, invest in the market.
Yeah, I think the point about the magazines is really interesting. I found that as well. I mean, they're mass market magazines, aren't they? So if the mass markets are talking about it, you've probably missed the boat, and the smart money's been in and moved out again. And so it's doing your own research again. It's keeping ahead of the trends. And almost, I think there was a comment he talked about with some of the magazines that look to the back pages.
Absolutely.
Don't look at the lead stories, because the lead stories are the ones that are now mass market news. Yep. But look for those stories that are upcoming and the new trends, and that's where the interesting developments could be. So that was quite interesting. I think for me, it was just a fascinating insight to get that journalist's point of view, especially around the 2008 crash, which I know you talk about a lot, and his perspective on, they were talking to fund managers and analysts all around then as it was building up to the crash, and nobody could believe that the banks could collapse.
It's an impossibility.
And I think there was some conversation that you had with him about that. It's almost a generational thing. Is if you've never experienced it in a generation, then it's like it's gone from the collective memory of investors. It can't happen. But actually, look back in the past. It's happened before. It'll happen again. And you also talked a bit about the sort of psychology of investors as well, which I remember. Which was very good. Another, some great comments on Twitter, and one comment here picked up some great points on markets during periods of volatility. And again, talking about what we're talking about, it's being aware of market developments and where you are in that market cycle. and all the different trigger points. And you and I had a conversation online, if you remember, about the lipstick index. Remember that?
Yes, you did. Yeah. Very
Which, if you've not heard of, apparently there's some correlation between the sales of lipstick and market instability and markets falling, that the sales go up because people focus on the little things that make them feel good. I thought,
very interesting.
Very interesting trend.
Anything that helps an investor improve and be aware of the market.
Yeah.
Absolutely.
Great. Okay. Well, let's hear a clip from the interview you did with John Stepek.
This is one of my questions, John, and I'll bring it in now and interrupt you, unfortunately. This is what I'm saying, right? So it starts in 2007. We're going to talk, because I was going to be like, you're in there at 2005. You're there, you get promoted. It's 2007 and things start to go pear-shaped. You're seeing all these things going wrong. You're seeing the signs. You're writing about it. You're showing all these investors out there and fund managers that read your magazine, because they clearly did and they were doing it at that time as well and still do. We're seeing all these warning signs. This is for Money Week. We're seeing all these you and Mary and all the other teams saying, watch out. And everyone's going, go away. We're not listening. Why do people, and psychology again, ignore the signs and they're always bullish until the very last minute, John?
Honestly, it's because people don't want to. Well, it's two things. I think the industry obviously has a bullish bias, because I do remember we had regular roundtables, so monthly kind of chats with fund managers that we'd put in the magazine. And I do remember that all the fund managers at that point were clearly very uncomfortable. They were clearly worried. But it's almost like, well, what are you going to do? If you're an equity income fund manager, you can't just say, actually, I'm really scared. I'm going to sell all my stocks and sit in cash, because, you've got a remit to follow. It's kind of, so I think it's very difficult for people in the industry to escape the fact that their job is to buy stocks, basically, and hold on to them. So I think there's that. So there's the industry side. As for individuals, I mean, this is where I think individuals have a bit of an advantage over professionals, or it's the advantage that they have, is that they don't actually have any kind of portfolio remit beyond make sure your money grows. And they also don't have any external pressure in terms of a boss saying, you have to turn around this quarter, you have to make X%. But the problem is that it's very hard to escape that the momentum, because it's a bit like today. Growth did so well for so long, and deflation for so long has been the big threat, that people simply cannot adjust to the idea that it's all going to be the other way around, because what has worked for so long, and we just have a tendency to keep extrapolating. And then when the turning points come, all of the things that you've relied on become useless, basically, because nobody really knows what an inflationary environment is going to be like. And also, in 2008, the idea that banks would go bust was unthinkable. Most people hadn't seen a major bank kind of like pop its clogs since, at least the 1980s. So I think that's the other thing. There's a lack of memory that these things have happened before. And then we go into it as if it's something completely fresh. So I think that's it. It's very difficult to turn course after being on it for so long.
Absolutely. And people have difficulty with it, and they try to just focus on where things were going well and forget about the bad times, psychology wise. Okay,
on to the last of our 5 chosen episodes. This one was very early on. Annabelle Brodie Smith, I think it was about episode 5 or 6, from the Association of Investment Companies. Now, what I really liked about this is really simple things for investors. She gave a great explanation of the difference between a trust and a fund, and also talk about, open-ended funds. And that was very interesting. And there was a conversation with you about VCTs and the advantages, the tax breaks for venture capital trusts. So that sort of information, as an investor, if you're really not sure what it is, having, I think I mentioned earlier about having a great communicator in finance, and Annabelle does a great job of explaining complex areas in a very easy to understand way. That is just so helpful if you're a new investor. Sometimes you might be embarrassed to ask the questions, you're doing the research, you're reading all the information, but you just don't really get it. Annabelle helps you understand these things. So that was great for me.
Yeah. When I interviewed Annabelle, I've known her for a little while, and she's so passionate about what she does, and she's been doing it for quite a while. And I actually interviewed her well before I'd interviewed Mark Dampier. That just came much later on, and I broke that interview trying to get her relaxed because she was a little bit nervy. And I said this to her with regards to what Mark had said, and I started the interview and I said to her, this is a shout out from Mark Dampier to the Association of Investment Companies, the trade association that represents most investment companies, and basically was calling the work and the body of work that she does, that they are the SAS of the trade associations. And I thought that was so brilliant, and it absolutely just made her day. So she does some fantastic work and has done it for 25 years and grown the organization immensely.
Absolutely. And she's also been an avid follower of the Investing Matters series, engages with a lot of the episodes. So thank you, Annabelle, for that. And we'll listen to your clip in a moment, which wanted to share this from Twitter. We had someone comment, a brilliant listen and interesting about the debates between growth and dividends. And very much from my own perspective, most of the investors that I talk to, a lot of people absolutely go for growth. And then there's a whole section that just go for dividends. And I think probably a mix of the two is probably the best solution, but it is definitely two different camps and two different strategies. So it was a great conversation.
Indeed. I think one of the other additional things that she's done as well is she's maintained a relationship with us at Investing Matters, because she retweets and shares some of the content because it's all about education. And she's very, very passionate about the whole educational side of things. So that's really good.
Excellent. Okay, well, let's hear the clip from Annabelle.
Annabelle, I want to move a little bit slightly across a little bit and talk about
Sure.
venture capital trust now.
Yeah, VCTs.
Yeah, VCTs, because a lot of people are moving into that, the importance of that and the benefits of that. Could you share that with us as well?
Oh, yeah. Well, venture capital trusts, for investors, they have very generous tax breaks. You get 30% upfront capital tax relief if you hold that for 5 years. So upfront capital gains, 30% relief. I can actually explain that a little bit better. Your rate of income tax relief is 30% back straight away. You can invest up to £200,000 every year, but you must hold those VCT shares for 5 years to qualify for that income tax relief. Also, importantly, any of the dividends you receive are tax-free. And that makes a big difference. But I think the best thing about them, actually, and obviously those generous tax breaks are very important, is that they are investing in the UK's smaller, fast-growing, ambitious companies. And those are the companies that are going to grow and support the economy in the future. Interesting, we talk to venture capital trust managers all the time. They're seeing, not surprisingly, lots of opportunities in technology and healthcare at the moment, which makes a lot of sense. But, those sort of companies have big economic and social benefits for the UK. They've been investing in these small types of companies, making sure they're strong through the pandemic, and they will be continuing to do that. So I think for investors, there's a great generous tax breaks, but they also have strong performance, and you are actually helping the economic and social benefits for the economy. So they are very, very interesting investments.
Yeah, I think that says the same regarding the investment companies per se, really. And when we last spoke, we were talking about anniversaries and all the rest of it. And you've been going since 1868. So, a lot of these investors are long-term investors, which takes me straight on to the dividend heroes and explaining to our investors what they are, and some of the strongest ones that have been going forward now, 50 plus years, some of them, in fact.
Yeah, well, this is actually very important. And again, it's a very important difference from open-ended funds, because investment companies have got a unique feature where they can hold back up to 15% of their income every year. They hold it, they're in reserve, in the revenue reserve. And then when times get tough, and boy, did times get tough last year. We all know about that
Indeed.
dividend drought, don't we?
Absolutely.
We all know about it. When times get tough, they can use this revenue reserve to boost their dividends. And that's the reason why investment companies with a dividend over 1%, last year, 85% of them increased or maintained their dividend, whereas just 23% of the equivalent open-ended funds did. So it's really, really important. We have 18 dividend hero investment companies, and 6 of those have been increasing their dividend every year for over 50 years. And investors find this incredibly reassuring. Growth is all good when it comes, but, actually have the reliability of that income. It means a lot. And growth is good when it comes, but we never know when it's not going to come. And then at that stage, those dividends really pay off.
Absolutely. I mean, this is the beauty of compounding the portfolio, compounding the investments in the portfolio.
Okay, so that was the clip from the interview with Annabelle Brodie-Smith. Now, they're our top 5, but we've had, at the time of recording this, 27 episodes, I think, of the podcast so far. So there have been a few other great episodes. And what I'd be thinking as well is going forward, we want to have an even more diverse range of guests on the program. And a perfect example is, recently you interviewed John Solarco, former Premiership footballer, now working in the field of business and investing. Another fantastic interview. A lot about football, if you're a football fan.
Yes.
but some real nuggets about determination and focus and everything that he had to do in his career and how he took that into the world of business now and investing. So that, for me, was another great episode I would definitely recommend people listen to.
Yeah, I think one of the beautiful things about John was obviously that Premier League football player, played for England, but also the fact he got in early in the property game and he was investing in property. And we know that a lot of our investors know somebody or have tried it themselves in the property game, and it's not for everybody. It's quite difficult. So the transition from being a professional athlete to then getting into investing, to then get into presenting and all the other things that he's involved in, I just thought was amazing. It just showed what can be achieved from just having the wherewithal to persist and have that perseverance. And I think all investors need that, because the markets will always try to just shake you out and try and force you to quit. And that's what it was about. That interview was about sharing the need of how to stay at something longevity-wise and then be a success. Very
much so. The dedication and commitment and perseverance.
Absolutely.
I think is the word to use.
Absolutely.
Which other one would you pick out as an episode?
I just loved the interview with Stephen Kelly, because it was a humble background. He was having to work from the age of, early teens to generate money for his family's home because his dad had got poorly. And going from there to being at the top of the game, Oracle, Chaudiant, Micro Focus, Sage, and then building a charitable foundation to help so many different people around the globe. And then thinking about, how can I do something more? So now he's working with the likes of Tech Nation, and actually he's inspiring and nurturing a whole different swathe of startups and entrepreneurs to actually develop their own business. And what he's passionate about now is about making the UK the tech superpower going forward. So I just loved that interview. It was the longest one I did.
Yeah, with 90 minutes.
And for someone to give us that amount of time, because that was very generous, was fantastic. So, just love individuals like that who are wanting to give and wanting to nurture and wanting to actually say to everybody else, give your time, show kindness, and possibilities are endless.
Absolutely. So I'm going to put you on the spot now. Who's your target? Who would you like to get on the program next?
That's a really good question. I would love to get some of the fund managers that are in America, and I'm trying to work on that right now. I'm not going to name names. The top of my list regarding UK fund managers, although some people will say he's no longer a fund manager, would be Neil Woodford. I'm working on that as well. But I'm looking forward to interviewing, hopefully if I get it across the line, some really, really significant individuals across the whole spectrum of the investment industry. But I'm going to keep those names under my hat for the time being, because I like to do things and then let people see them afterwards and then go, oh, didn't expect to see that person. And we're going to have some interesting guests in 2023.
Fantastic. So obviously, if you're listening to this episode, we'd love to hear your thoughts as well. Who would you like us to have on the program? Who do you want to hear from about investing matters and what it means to be a good, if not great investor, and how to constantly improve? So do engage with us on our social media. You can do it on Twitter, on LinkedIn, on Facebook, and let us know who you'd like on the program.
Indeed.
Right. Well, I'm just going to say thank you very much to you, Peter. I was delighted that you took up the offer a year ago when we talked about being the host of the program. Fantastic results so far. Looking forward to the 2023 episodes. And here's to a very positive future and learning more about investing matters.
Thank you, Dave. I'm looking forward to it as well.